Good afternoon and welcome to the OBR's press conference on our March 2026 economy and fiscal forecasts. I'm Laura Gardner, Chief of Staff, and I'll be chairing today's event. I'm joined by the members of the Budget Responsibility Committee, Professor David Miles and Tom Josephs. As you will likely be aware, Richard Hughes resigned as chair of the OBR in December, meaning we have been jointly led by David and Tom in the absence of a chair throughout this forecast. The BRC and OBR staff greatly appreciate Richard's leadership over his 5 years in office, and we hope that this forecast continues his commitment to rigour, objectivity and transparency. In a demonstration of their joint leadership, David and Tom will, in a moment together, run us through a summary of the forecast that we've just published, after which they'll take questions, both from those here today and those joining us online. If you're watching online, you could submit questions at any time on Slido, which you could access via the link on our website. Before that, I should start by thanking, on behalf of the Budget Responsibility Committee, staff at the OBR, the Treasury, and in other government departments for their expertise, perseverance, and flexibility in putting this latest forecast together. Of course, all of the analysis and conclusions continue to represent the BRC's own independent judgments. With that, let's hear from David first, and then Tom.
Thanks, Laura. Good afternoon, everybody. This spring forecast from the OBR is really an interim update on the economic fiscal outlook ahead of the next budget. But as many of you will know, today is not the day to provide a formal assessment, a pass-fail judgment almost, on whether the government's on track to hit its fiscal targets. And that's precisely because it is not a budget, it's not a major fiscal event, and the intention of the government is to have one fiscal event a year, one budget. And it makes sense that the formal assessment of whether the government's on track to hit its fiscal target should be made at that point, when the government has made adjustments to the fiscal position, partly in the light of the OBR's so-called pre-forecast, pre-policy forecast as to what would happen in the absence of any changes. So today what we do is provide an updated and I think broad picture of the economic and fiscal outlook. As you would anticipate, the military action in Iran and right across the Middle East began as we were finalizing the forecast, and the events of the past 3 days do one thing, which is just illustrate how quickly the economic environment can change. And there is indeed a great deal of emphasis on our forecast today about the range of uncertainties around a central forecast. And it's a central forecast which hasn't been updated just in the last 48 hours to reflect some movements in market prices. Some of those movements are very substantial. Oil prices are up at least 12% or so on where they were on Friday, and a little bit more relative to the point at which we took a fix on the market expectations of both the spot prices and the futures prices. Gas prices up considerably more than that. It's not right, though, I think, to assume that all the market developments over the last week or so have been in the direction of making the economic and fiscal outcomes more difficult. For example, stock prices, despite having fallen rather a lot in the last couple of days, are still rather above the point at which we took our estimate of market determinants a few weeks back. And gilt yields, as people will know, have risen very substantially in the last 48 hours, but they sit around about where they were when we took our estimate of the market yield curve and where that might be going a few weeks ago. This EFO, as I say, focuses very much not just on a central forecast, but on a range of possible outcomes either side of it. That range is large, and we give estimates in the book on the probabilities that economic and fiscal aggregates fall within ranges either side of the central forecast. One thing that hasn't changed very much in the last few days, and indeed in the last several months, is that this is a forecast made, and this is a government that faces a situation which is very challenging fiscally. The chart on the right illustrates just how much in the UK the stock of debt relative to GDP has increased, a reflection, of course, of what's in the left-hand chart there, which is the scale of borrowing. Governments for many years now have been borrowing around about 5% of GDP a year, despite plans at many past fiscal events to try and bring that down. There's been a series of shocks and ongoing low productivity, which has made it very difficult to bring borrowing down. And successive governments have set out medium-term plans to reduce borrowing, which have subsequently often been pushed back due to the impact, as I say, both of shocks and ongoing extremely low rates of growth of productivity, at least by historic standards. At the same time as borrowing has been high and the stock of debt has moved to unusually high levels, the tax take out of GDP, as this chart illustrates, has been on a rising trajectory for several years. Indeed, looks set to reach a level which is amongst the highest, probably is the highest, since the end of the Second World War. And I would say that both what's happened to the tax take, which is a determined effort to control the growth of debt, and what has happened to the scale of borrowing and the size of fiscal deficits really are symptoms of, more than anything, one underlying cause, which has been a very slow growth in productivity, which really goes back at least to the financial crisis of, what now, 17, almost 18 years ago. So much for where we are now and where we have been. Let me turn to our latest forecast. And I think the central forecast really hasn't moved very dramatically from where we were in November, where we assumed that productivity growth would run at around about a level of 1% a year. That was a central forecast, considerable uncertainty about it, something I'll come back to in just a moment. There has been a slight change in our assumption about labour supply, largely driven by what was really a substantial change in the Office for National Statistics assessment of the scale of net immigration, and more specifically a change in their measure of net emigration by British nationals, which is now estimated to have been very large relative to the previous forecast, something like 85 to 90,000 a year, more people leaving the UK net than the ONS had thought. We've taken that on board and assumed that that higher level of net emigration of British nationals runs at a level which is actually pretty close to the average over a longer period now, and reduces the scale of net immigration by around about 60,000 a year, which has knock-on impacts on the size of the labour force in the UK, and has a marginal but not entirely trivial impact on the rate of growth of aggregate GDP, but virtually no effect on the rate of growth of GDP per capita, which is a measure of living standards and more relevant in many ways as a measure of economic health than is simply the rate of growth of aggregate GDP without any adjustment for changes in population size. Growth at the end of last year was disappointingly weak, and for the first few months of this year doesn't seem to have picked up very strongly. And so on the back of that, something which we judge to be a temporary cyclical slowdown more than a structural event that shows that growth is going to be significantly weaker than we thought back in November. But on the back of that, it does mean that our projection for the most likely rate of growth for the economy this year is a bit lower than it was in November, having been reduced to about 1.1%. But because that is judged to be a cyclical short-run event, which increases the amount of slack in the economy, as that slack gets used up gradually over the next 4 years, it actually means that growth from this point forward is a little bit higher than we thought in November, to take the level of GDP pretty close to where we thought it would be a few months back. I think what will happen to inflation is particularly uncertain in the light of what's happened in the last few days. As I mentioned earlier, and as we all know, very large increases, particularly in gas prices and also in oil prices. Our central expectation had been that inflation would fall back toward the Bank of England's 2% target during the course of this year and be about at that level at the end of the year. There must be more uncertainty about that right now, although I would note that if one is thinking about the inflation impact of what's happening to oil and gas prices, I think it's more relevant to look at futures prices than spot prices, and the futures prices of both oil and gas have not spiked up anything like the same extent as the immediate trade prices or spot prices, which suggests that one might exaggerate the inflationary impact if one just looks at spot prices of oil and gas. That's all really I wanted to say as an overview of the central forecast, and Tom will focus much more on the fiscal outlook than I have in just a moment. Perhaps I might finally just emphasize one thing, which is just how much actually, can we go back, Laura, if you don't mind? Can we go back to that? Just how much of the extremely challenging fiscal position that the UK is in reflects low growth in recent history. And if you look at the chart on the right, it's just where you might have anticipated the level of GDP in the UK to have been over the last several years. If you take where the level of GDP was on the eve of the financial crisis, early 2008, and assume that GDP had followed the trend line that it had been on for much of the previous several decades, we would have followed the dotted line. The solid line is the path that GDP has actually followed, including our forecast, our central forecast at the end of it. Right now, the level of GDP per person in the UK is around about 30% below where it would have been had there not been a profoundly different trajectory for productivity in the period since the financial crisis. It is not surprising on the back of that the fiscal situation in the UK remains very challenging. What happens next is difficult to forecast. The central forecast we make about productivity growth, and I'll conclude on this point, is that it should run at around 1% a year over the next 5 years or so, and perhaps beyond. As you can see, productivity growth in different periods in British history have really been rather variable, as high as 3.5% or so, almost 4% in the 30 years between the end of the Second World War and the mid-1970s, still substantially above recent levels, running at about 2% between the mid-70s up to the financial crash, less than 0.5% in the period since 2011 up to last year. Our central assumption there is one about which there is a substantial degree of uncertainty, and in the report, and I think Tom might mention this briefly in a moment, there are alternative scenarios where productivity growth moves back up to about 1.5% rather than the 1% central forecast, or falls back to little higher than it's been over the last decade and a half. So uncertainty around the forecast remains very substantial, and that's why I think, particularly in chapter 6 of the report, there is a great deal of emphasis about alternative possibilities to the central forecast. And I think the last thing I'd like to say is that when one thinks about forecasts from the Office for Budget Responsibility, although there is a tendency to focus on the central forecast, and there are lots of tables in our reports about a central forecast, in many ways what is more significant and more important than that is the range of outcomes either side of it and the probabilities of being one side or another of that central forecast.
Okay, thanks very much, David. Afternoon, everyone. So I'm going to briefly describe the updated central fiscal forecast, and then I'm going to say a bit more about the risks and uncertainties that David has highlighted around the central forecast. So this slide shows the changes in the borrowing forecast since November, and overall the fiscal outlook is actually very similar to the forecast we produced in November. So the forecast for receipts is slightly stronger than November. That is mainly due to the fact that we've had stronger than expected equity price growth since November, and that boosts capital and stamp taxes, and that reduces borrowing compared to November by around 13 billion by 2030, which is shown in the blue bars. Changes to the spending forecast have been very small compared to November. Borrowing is lower by just 2 billion, spending is lower by just 2 billion in 2030. That's shown in yellow. And then the policies that the government has announced since the budget last November add around 4 billion a year to borrowing from next year. That's shown in green, and that is mainly support for local authorities next year, and then additional funding for special educational needs from 2028-29 onwards. And so all of that means that overall borrowing in 2030 is projected around 8 billion lower than forecast in November, and that is a very small change in the context of the uncertainties around the central forecast that David has talked about. And that means that the path for borrowing as a share of GDP looks very similar to November. It is projected to fall from 4.3% of GDP this year to 1.6% in 2030-31. And the fan chart shows the probability distribution of possible outcomes around that central forecast, reflecting the wide range of risks and uncertainties that David has talked about. That forecast decline in borrowing over the next 5 years is primarily driven by a forecast increase in the tax as a share of GDP. Again, very similar shape to November. So that is forecast to increase to just over 38% of GDP in 2030, which would be a historic high for the UK and is about 6 percentage points above the pre-COVID level. And then by contrast, spending, as you can see, is broadly flat, or projected to be broadly flat over the forecast period at around 45% of GDP, and that's around 5 percentage points above where it was pre-COVID. And so that projected fall in borrowing means that measures of public sector debt are all expected to broadly stabilise and fall very slightly towards the end of the forecast. And again, that is a very similar picture to our November forecast. But as David has mentioned, debt would be stabilising at a level which is about 3 times above the pre-financial crisis level and is high relative to the advanced economy average, and means that public finances are more vulnerable to risks and shocks. And that is why understanding the potential impact of those risks is as important for fiscal policy making as is understanding the central forecast. So David's talked a bit about the risks from the conflict in the Middle East, which clearly creates very significant risks for the global and UK economy. We were not able to include any estimate of those impacts in the forecast because of the fact that the military action that took place at the weekend obviously came well after we'd closed the forecast. It's also the case that those impacts are, at the moment, clearly very uncertain and will depend on how the conflict evolves and the impact on energy markets, trade, and financial markets. As of market close yesterday, spot oil prices were about 20% above the prices that we had used in our forecast, and gas prices about 25% above. Gas prices in particular have increased again today very significantly, I think about 50% above where we closed the forecast, but a lot of volatility today. And as David mentions, futures curves suggest the market is currently expecting that to be a relatively temporary spike, and that prices would fall back towards forecast levels within 1 to 2 years, and that is relevant for the impact on our economy and fiscal forecast. In terms of the potential impacts on the public finances, an energy price shock would be expected to have a negative short-term fiscal impact pushing up the cost of welfare, debt interest, and potentially also departmental spending, and likely to have only a kind of small offset from higher tax, mainly through North Sea revenue, on the basis that in the short term, you would probably expect there would be limited pass-through of inflation to the key tax bases, such as wages. Over the medium term, you might expect more feed through to the tax bases, which could provide more of a fiscal offset to the higher public spending. But looking at other market determinants, as David mentioned, despite a sharp increase this morning, 10-year gilts rates are still slightly below the rates we used in our forecast, and equity markets are still around 3% above the levels we had in our forecast. We look at lots of other risks in the report in a lot of detail, including around productivity growth, trade policy, unemployment, and equity and government bond markets. And these all represent both downside and upside risks to the forecast, which are assessed in the report. And in addition, we look at risks within the fiscal forecast, so the risk that the rising tax take could mean that incentives within the tax system constrain economic activity by more than we are expecting. There are a number of pressures within departmental spending, including in defence, health, and special educational needs, and also a question around whether the rapid recent growth in health-related welfare caseloads will continue. And then finally, looking further ahead, there is also significant pressure likely placed on the public finances over a longer time frame by demographics and ageing population. So each year in the summer, we publish a fiscal risks and sustainability report, which include long-term projections of the public finances. This chart is from the 2024 report, and we will be updating this in the summer. And this shows that based on kind of current policy settings, the increased cost of healthcare and pensions driven by demographic trends in the long term would put debt on a clearly unsustainable upward trajectory. And that path becomes kind of unsustainable even more quickly if you assume the UK is hit by a major economic shock roughly every 10 years, which has been the case over the past two decades. So this really underlines the risks associated with the UK's current elevated debt position. So we will stop there, and very happy to take your questions. Laura.
Thank you, David and Tom. We've got a lot of enthusiasm in the room, which we will come to first before I turn to some questions on Slido. So this hand definitely shot up quickest. So let's start here. If you could tell us who you are and then what your question is.
Joel Hills from ITV News. I have a couple of questions, if I can. The first, David, I think probably is for you. As you point out, energy prices are materially above your forecast assumptions. If they stay here, at what stage, when do they start to have a material impact on growth and living standards here? And Tom, I have a question for you as well, please. A week ago, two previous chairs of the OBR bemoaned in front of MPs the fact that no government had ever managed to stick to its fiscal rules. It's always, routinely, they had overspent. Do you think this government will manage to stick to its spending plans?
Well, you've done my job for me and fielded the questions to the committee members, so we will start with the question for David.
I mean, so I think different prices in the economy are affected by energy price rises over different time horizons. Some price effects would come through relatively quickly, within months, maybe even weeks, which would be the price of petrol and diesel that people buy. Energy price on household bills would be in a different category because they depend on operating formulas, which wouldn't kick in for several months. There, I think it becomes very relevant, the difference between spot prices and what futures prices. I mean, I'm just looking at a picture. This is yesterday, where spot prices, this is Brent crude dollars a barrel, were at about 78, 79. They may be a bit higher right now, I suspect. But by February of next year, the futures was down to 68, 69 or something like that. And so there it would be because of the time lag, I mean, if you think the futures is a better guide to where the prices will be than today's spot price, obviously you get a much more limited impact on things like household energy bills than just looking at, the 12, 13, 14% higher now than they were on Friday, which you get out of the spot price. I mean, there's a kind of rule of thumb that empirical work over the last few years suggests as to an overall effect of energy prices, which is kind of really, what they mean by that is, I think, a mix of gas and oil reflecting the relative uses of gas and oil in UK consumption. And that rule of thumb, if I remember rightly, is something like for a 10% increase that's persistent, it might add somewhere between a quarter of a percent and 0.5% to the level of prices. We've had more than 10% on spot prices, it's nearer 20. If the futures are wrong, and that's just the new level now that you stay at, and using these rules of thumb, I mean, you get, that's going to be somewhere between 0.5% and 1% on the level of prices. So meaningful, I mean, way short of, we're not talking hyperinflation, this is not 1974 in the UK. But it depends very much on what happens to those spot prices and the futures prices.
It's not 1974, but a lot of people are worried that what we're facing potentially is another energy price shock. We just lived through.
Yes, but I mean that could happen. I don't think we're anywhere close to it yet. I mean, gas prices after the Russian invasion of Ukraine were up hundreds of percentage points. Right now, spot prices for gas, which have moved around quite a lot today, are up maybe 50, 60%. At one point, they were a little bit higher than that, although the futures were nowhere near as high as that. So I think we're right now, I mean, if things just stop as they are right now, we're a long way short of where we were after the Russian invasion.
Thanks, David.
Yep.
We'll take the question for Tom, and then I will definitely come to everyone in the room. Your former bosses were out last week, but the question was about the government's spending plans.
Yeah, so it is the case that we've analysed in previous reports, looking at reasons for differences between our forecast and outturn, that a big driver of that is that when it comes to allocating spending in spending reviews, governments will tend to increase the amount of spending they are doing compared to their previous plans. And that's an observation about the past. That is not to say that will happen in the future, but it's definitely happened frequently in the past. I mean, this government increased public spending substantially at their first budget in October 24, with relatively high rates of real growth in spending penciled in the kind of near term, and then lower rates of growth in the final few years of the forecast. And we do analyse in this EFO that there are significant pressures within those spending allocations, both within the current spending review period and beyond. Those are in areas such as health spending, in defence spending, obviously, given the current geopolitical situation, and pressures around special educational needs, which the government has actually provided quite a lot of additional funding for ahead of this event, but around which there are certainly still quite significant pressures. And then looking beyond the spending review period, we have some analysis of what the kind of penciled in assumption for spending growth implies for spending allocations to departments outside of those ones where the government has made a kind of clear commitment, such as in areas like health and education and defence again. And that does imply for those departments that what we call unprotected don't have that commitment in place, that they would be looking at sort of settlements of around, I think, cuts of 4.4% in real growth, so a pretty tight outlook for public spending.
Thanks, Tom. Okay, we'll keep going around the room. We'll work from front to back, and let's have a go asking one question each, and then I'll try and come round again. Joel didn't get us off to a good start. We'll have a go.
Hi there, Jack Barnett from The Times. You mentioned that the the emigration from the UK has been substantially higher than what was previously expected. Could you just provide some colour around that as to the reasons why people are leaving in greater numbers than you previously expected? Is it to do with the increase in the tax burden? Can you just provide a bit more insight as to why it's happening?
Yeah, it's a good question. I think what's actually happened is this, that the Office for National Statistics, after COVID, when it no doubt became more difficult to measure these things as much else, had come up with estimates that net emigration of British nationals, which had been running at, from memory, 80 to 90,000 a year consistently for many years, actually went to close to zero. And that's been their more recent estimates. They've now looked at their methodology and they've actually reassessed the past so that there wasn't a reduction in net emigration of British nationals from the UK, and that it actually stayed at pretty steady levels, which were about 80 to 90,000 higher than over the last 4 or 5 years than what they'd estimated. So actually what's happened is that they've reverted to a pattern which now makes the last 4 or 5 years look very similar to the previous 10. It seemed easy for us then to say, well, what do we do for the next 5 years? Well, since they've now got a sort of flattish line about the level of net emigration of Brits, let's assume that that's where we go from the future. And that's driven the 60,000 less net immigration into the UK for the rest of our forecast horizon. So I don't think it's quite a case of they've suddenly discovered that there's very many more people leaving the UK than was the case on average over the last 10, 15 years. It's rather that they've reversed an assumption that they had made, that there was a reduction in net emigration. Sorry, I'm making a song and dance about that. So in a sense, I think that the question, why that happens, sort of in a way goes away, because nothing unusual looks as if it has happened now in the last few years.
Thank you. Let's go to these two gentlemen, and then we'll get to this side of the room. So David Robinson first.
Thank you, David Robinson, Market News. If I can buck the trend by asking an upside risk question, and that is your earnings forecast. The Bank of England has latest assessment 3.25 as inflation compatible, target compatible earnings. You have gone again for next year for 2.25. You have a fair number of MPC members worried about it being sticky at high levels. Why are you so pessimistic, and is that something that's going to be up for review in the autumn?
David, why are you so pessimistic?
I'm not a pessimist, I think, on the whole. I think it's partly a reflection of an inflation forecast, which is inflation coming back down toward the target level, and it's been, as you know, David, materially above it for much of the last few years. Now, of course, that could get blown off course by what we've just been talking about and the energy situation there. That's very unclear at the moment. So it's partly that. I mean, it's also a reflection of what is pretty clearly a cooling labour market. One thing I didn't mention before was that the forecast now is for unemployment to be meaningfully higher than we thought back in November. I think last year we thought unemployment would stay just a bit south of 5%. Now it looks like it's heading toward 5.25%, maybe 5.5%, pretty quickly. And hiring has dropped off very materially in the private sector in the UK. So it's that combination really of a central forecast where inflation does keep gradually coming down, and a weakening labour market and more slack. Now that slack goes away as you look further ahead in our forecast, but explaining the relatively low level of wage settlements, 2.25% or so next year, is really a reflection of those two things.
Tom, you just want to add something?
I just was going to add that, I think you're very right to highlight this judgment, because it is really important in terms of the fiscal forecast. Nominal earnings are a really big driver of the receipts outlook. That is showed by the fact that in our previous forecast at the autumn budget, despite the fact that we revised down productivity, the forecast actually improved because we had a stronger earnings forecast. And we have some scenarios in the report this time, which illustrate the sensitivity of the forecast to earnings. We also have some scenarios looking at potential different paths for unemployment over the next 5 years. And an interesting result from those scenarios is that what matters for the fiscal position is not the impact so much on the welfare bill, as you might expect, but actually the impact on the earnings forecast.
Thanks very much. This gentleman here next.
Harrison Moore, Market News. A somewhat similar question on your scenarios on productivity growth. You say on page 13 of the report that productivity growth resulting from AI could see borrowing 50 billion lower by 2030-31, but you also have a technological displacement scenario where rising productivity leads to substitution of human labour and therefore lower tax receipts, and so borrowing 9 billion higher. So does AI at the moment pose risks both to the upside and downside, and what data will you be looking at to see on which side we may be coming out?
I think there's two aspects of AI which I think are very uncertain. The first is just what does it do to productivity? And last year, or the current Nobel Prize winner, or one of the current Nobel Prize winners in economics takes a particular view on that. The person that won the Nobel Prize 2 years earlier than that, and they are probably the two people in the world who've done most research on the impact of AI, is in a completely different place. So who am I to know what the answer is? Darren Acemoglu, who won the Nobel Prize a couple of years ago, thinks that actually the impact of AI on productivity over the next 10 years is next to nothing. I mean, it's just extremely small. Cumulatively over 10 years, a small fraction of 1%. Philip Aghion is one of the current winners of the Nobel Prize this year, thinks it's about 10 times bigger than that. So that's a sort of indication of the range of uncertainty about its effect on productivity. There's another aspect of the uncertainty, which is whatever impact it has on productivity, and let's assume it's meaningful and significant, is that good for employment, or at least not bad for employment, or is it very bad for employment? The very bad for employment view would be that AI is just a straight substitute for labor, and that companies that currently employ 1,000 workers will just say, well, we only need 750, and we'll produce the same output, or maybe even more, with the fruits of AI. Or another view, which is actually it's more like a complement than a substitute for labor. So it means you get the extra output and don't just produce the same amount, but you increase the productivity of your workforce, thereby making them equally attractive to employ, and it boosts output by much more than the straight substitution story, and it's a complement, and it increases the productivity of every worker that you've got. We do a couple of alternative scenarios, one of which is if you like, the pessimistic displacement one, where companies produce the same output, but they can just get rid of 20% of the workforce, and that's bad for tax revenue. I mean, it's most important. It's bad for the workers, but I mean, it's bad fiscally as well. Partly because even though it might boost profits and reduce the wage bill, the average tax out of labour income is higher than the average tax out of corporate profits. So that switch is bad fiscally. Of course, the more positive scenario is you get the productivity impact, and it comes at no cost to employment. Some of the gains of that are shared with real wages, and both profits and real wages are high, and that's fiscally highly beneficial. I think the tricky thing at the minute is, and that's why I mentioned this thing about the two of the latest Nobel Prize winners, people who've spent years thinking about this stuff are just coming to very different conclusions on this right now.
What data are or will you be looking at to see which of these scenarios is more plausible?
I think it's going to be tricky to be sure about which is more plausible by just looking at the monthly reports on employment and wages over the next year or even 2 years, because this really is a kind of 5-10 year phenomenon. But that's the main thing to look at. What's happening to employment, what's happening to measure productivity, what's happening to wages and profit margins. And I think you'll have a better idea a year from now than one has right now. Let's put it that way.
We'll go to the the lady at the back, and then these two gentlemen, and then I will take some questions online.
Thank you, Aaron also from Telegraph. I just had a question on the Middle East again. If we do see sort of persistent conflict and persistent pressure on energy prices, could you just explain a bit on how that would impact growth and unemployment in the short and the long term? Obviously, we hear a lot from factory bosses in the UK that energy prices are a major concern for them. So yeah, just
yeah. I mean, if we see energy prices rise as much again over the next few weeks and stay there, and that just becomes the new normal, and it's 20, 30, 40% higher energy prices, I think that's a material impact on inflation because it'll largely get passed through. It's not the kind of inflation that can help fiscally, so it's unambiguously bad news. I mean, the UK is a major importer of energy, so there's nothing good about energy prices being higher. I mean, there are some sorts of inflation which you might call domestically generated inflation, which are fiscally quite helpful, particularly when you've got threshold freezes, which then push people into higher tax bands. But this is not like that. This is all an increase in cost to the UK. It is a hit to the standard of living in the UK. It's not fiscally in any way helpful, partly because you've then got some welfare benefits that are uprated in line with inflation. So it costs the government, doesn't generate any more revenue. It's pretty much bad whichever way you look at it, on households and on the fiscal situation. I mean, it takes a bit of a while to play out. Going back to an earlier question, some prices might adjust quite quickly to higher energy prices. Others where people have got fixed contracts and they're only adjusted once every year or so. And there are uplifts in the regulatory rules about how much energy pricing can go up. So it's something that will play out gradually over the rest of this year and into next year. But energy-driven higher inflation is unambiguously bad for everybody in the UK.
Quick follow-up then.
Sorry, yeah, and can you just say specifically what that would mean for growth and unemployment? So bad for inflation.
Yeah, sure. Yeah. Well, it's also an increase in it's an increase in the cost of production, because pretty much every firm has to use energy. Some companies, of course, are extremely energy intensive, where the energy bill is a really substantial part of costs. But there's no company that employs anybody that isn't affected by this, and that's a squeeze on profitability unless you can pass it through in higher prices. But then the question is, do you get pushback from your labour force? Probably there's some sharing of a burden. When there's an increased input price that comes from outside the country, everybody's going to have to take some pain somewhere. Part of it will show up in lower real wages, part of it will show up in lower profitability. To the extent that there's very strong pushback in the labour market from any reduction in real wages, then the burden will fall more on reducing the levels of employment, because labour's gone up relative to the profitability of employing people. So it feeds through to real things, and not real things like employment and GDP, as well as the price level.
Excellent. This gentleman here.
Thank you. Tom Knowles of The Guardian. You've sort of touched upon this, but there's been quite a chunky upward revision to unemployment to 5.3% in 2026, and then revised up every year until 2029. Can you explain what's driving that? What's changed since November? And are young people going to be bearing the brunt of that rise in unemployment?
Yeah. I mean, I think what's changed is that the data's just turned out to just get weaker in a way that we hadn't anticipated back in November. So we're just sort of marking it to market in a sense about what's happened in the last few months. And it's not just the actual data on unemployment and employment. It's also surveys of what it looks like companies are doing. And most of it has come about as a result of companies cutting back on new hires rather than laying lots of people off. And we haven't gone into a mass redundancy phase in the UK, thankfully. And because it's significantly on new hires, you'd expect it then to have a disproportionate impact on people joining the labour force and trying to find jobs for the first time. And that does seem to be happening. There's worrying numbers on youth unemployment in particular. where you're seeing not only the impacts of wages have been running a bit ahead of inflation and probably a bit ahead of productivity, which is why there's been a bit of an increase in the real cost of employing people. And on top of that, you've got things like minimum wage uplift as well. And we think that's got a little ways further to run. Nonetheless, further down the road, as you rightly point out, I mean, it's a forecast, a central forecast at least, in which unemployment does actually gradually then get back to the levels we think of a kind of long-run neutral for the UK, which is somewhere a bit north of 4%, and not the 5.5 or so you get 5.3 you get to.
Have you seen anything about the government's, equalising national minimum wage or national insurance contributions affecting that too?
Well, to the extent that I think disproportionately increases the cost of employing very young people, you would naturally enough. I mean, it doesn't take an complex economic model to work out that's where you'd expect to see the unemployment showing up more, and that does seem to be the case.
Thank you. And we'll take a question here, and then I will go to slide 8.
Thank you very much. Will Hazel from the iPaper. David, you talked about the fiscal situation remaining very challenging, about that increase in fiscal headroom being very marginal. It sounds like there's no great bonanza in this forecast for the Chancellor if she were to look in the next few months, or want to look in the next few months at new spending commitments, perhaps changes to the student loan system, higher defence spending, or even greater cost of living support if these inflationary pressures continue.
I think that's reasonable what you say. I don't think there's a great bonanza here. I don't think, just listening to Chancellor speaking in the House earlier today, I don't think she was actually saying this was, fantastic bonanza, and she outlined the scale of the change, at least in the central forecast, on the sort of headroom on the main fiscal target, which is the current balance, which has gone from, again, these are all point forecasts, and the uncertainty around them is large relative to the absolute number. I mean, we were at 27 and a bit billion, it's now nearer 24 billion. But I don't think anybody would describe, a few billion more in an economy where the government spends 1,000 billion as being a bonanza. And I don't think I heard the Chancellor saying anything inconsistent with that, really. So it's gone in the right direction, but by a very small amount in the context of uncertainty and the kind of shocks that you always expect to be hitting the economy.
Thank you. Right, I should take some questions online. I'll have another look for any final questions in the room in the next few minutes. I think we'll come to you, Tom, and give David a break. I should say we've had quite a lot of questions online about the conflict in the Middle East and unemployment, including our scenarios, but I think we've covered them quite comprehensively, so I won't repeat those. So I'll talk a little bit on the spending side, Tom. To what extent do the policies to compensate local authorities for send deficits and top up Department for Education spending solve the problem of local authority finances?
Okay, thanks. So at the autumn budget, we identified two sources of pressure on the public finances related to special educational needs. The first being that the government at the budget said that it was going to fully fund special educational needs from within central government departmental spending, and we estimated that would cost around £6 billion in 28-29, so a very significant pressure. And the government last week, in the reforms that they set out, announced that they would be allocating an additional £4 billion over and above the previous spending review settlements to address that pressure. So that is obviously, a material increase in spending to address that risk. They've also said that they will allocate additional funding from within the Department for Education's budget that was previously unallocated to also pay for some areas of SEND policy. But I mean, it's still the case that this is definitely an area which will continue to create risks and pressures on the public finances, given the impact of the government's reforms are clearly at this stage still quite uncertain. The other area of pressure that we identified was the fact that local authorities have been previous and do still until 28, 29 continue to fund this policy area, and they had built up on their balance sheets a stock of deficits related to past spending on special educational needs, which they had previously been able to essentially disregard when it came to meeting their statutory requirements to balance their budgets each year. And those deficits had built up very significantly, so that if local authorities had to recognise them on their balance sheets, many of them essentially would be technically insolvent. So again, earlier in the month, the government announced it would be reimbursing local authorities for 90% of the current stock of those deficits, and that involves a £6 billion transfer from central government to local authorities. So again, that goes some way to mitigating that pressure, but local authorities will still, until 28-29, be accumulating further deficits, and the government has not yet said how it will deal with those in 28-29.
Thanks, Tom. We've got a couple of questions on the tax take, so I might come to you first, Tom, and then perhaps see if David wants to add anything. Sue Chan at The Telegraph asks, why is the tax burden going up? And John Paul Ford Rojas asks, can you explain a bit more about your warning in the EFO that a higher tax take can distort or constrain economic activity? How might that manifest itself, and what would the implications be? Tom, do you want to go?
Shall I take the first half of it, and David can do the second? So on why is the tax burden going up? So there are two main drivers of that. One is an increase in personal taxes, income tax in particular, and the other is an increase in capital taxes, capital gains tax, and other asset taxes. The first, the increase in personal taxes, is very much driven by the policy of freezing personal tax thresholds, which, combined with relatively strong nominal earnings, pushes up tax as a share of GDP pretty significantly in the forecast. So I think that accounts for around 2/3 of the increase. And as I say, capital taxes account for the other third, approximately. And that is a combination of the fact that we assume reasonably strong asset price growth in the forecast, both in terms of equities and property in particular, and also the result of a number of policies that the government has introduced since the October 24 budget to increase the tax raise from capital taxes. But David might want to say more about the potential impact on economic activity.
Yeah, well, in a sense, why it's happening is that it's taking most of the burden of trying to bring the amount of borrowing down from about 5% of GDP to 1% or so of GDP. Something's got to give there. Either you, in the absence of hugely higher rates of growth in GDP, some combination of spending being controlled relative to GDP or taxes going up relative to GDP is needed to close some of that gap. And much of it has been done through a trajectory of higher tax take out of GDP. And it's very difficult, I think, to increase the tax take out of GDP without having some negative effects on incentives somewhere in the system. They could be incentives to work if it's largely falling on employment income. They're about incentives to save to the extent that taxes on returns on saving might be increased, or they're to do with the incentives to employ people if the significant part of the burden falls on employers. So somewhere, somebody's going to be facing slightly higher disincentives to work, save, invest, employ people. And it's very difficult to avoid that if you've got the tax take out of GDP rising by fairly significant amounts, and it will be significant on our central forecast relative to just before COVID. Something like the tax take out of GDP will be 5% higher, 5 percentage points of GDP higher. Now you can try and be clever about it all and increase taxes in a way that doesn't do any damage to incentives, but it's easy to say that. And if it was as easy as let's just find a way of doing it that doesn't distort incentives, well, somebody would have done it already. So it's pretty difficult to do that. And it's very difficult to do that if at the same time you want your tax system to be very substantially redistributive, which is understandable that governments would want that, because that can generate higher marginal income taxes than the average rate of tax. That's how you make the tax system, in some sense, increasingly redistributive. But it's higher marginal tax rates that do the real damage to incentives to work, save, invest, employ people. So that's the difficult thing about the route to fiscal sustainability, which involves increases in taxes. But you've got to do something. And to say that, well, do something else then, if the something else is let's squeeze spending relative to GDP, then the question is, well, so which bits do you want to squeeze? There's no easy answers there. Of course, the painless way to do it is if miraculously one could increase the rate of growth of the economy, and in particular, productivity. But if we knew how to do that, we'd have done it already. So when you're in a difficult situation like this is not unique to the UK, this is true for lots of rich countries, it's a bit of a hard slog, and it's going to be difficult.
Thank you. Can I check if we've got any final questions in the room? Okay, let's try and make them quick, and we'll get them both in over there first.
Thank you. Just on disincentives to work, do you see those as being biggest for lower earners, higher earners, or those in the middle? And what would be the drivers there?
I mean, I think there are some quite high marginal tax rates at different points of the income distribution. It can affect people on relatively low earnings, particularly as people become taxpayers for the first time. There's a jump up in the marginal tax rate. And to the extent that some benefits are withdrawn as you start earning more money, that's effectively an extra tax as well. So that can affect people at the lower end of the earnings distribution. Then there's people who are, not the highest paid in the economy at all, but who can face quite high tax rates again as you increase the marginal tax rate from the income tax rate, from 20 to 40 to 45. And then you've got withdrawal of some other benefits that occurs slightly higher up the income distribution. So I think it affects people, right across the distribution of wages, really.
Jack, a final question from the room down here.
More of a procedural one. Are you confident you'll be able to publish your forecasts independently? Because obviously the Treasury published your forecast today at the budget in autumn. And when is the new chairman going to be announced?
Well, on the second question, it is the Treasury who runs the process for appointing the new Chancellor, so you'd have to ask them about that one. On the first question, I mean, yes, we're very confident that we can... Did I say?
You said Chancellor,
I said, sorry.
but you meant Chair.
Chair.
They're important. We agree
sure
they're important, Tom.
Don't appoint the Chancellor.
Okay, cut that bit. Chair.
Sol Coral from the OBR.
On this first question, so yes, I mean, we're very confident that we can continue to publish independently. We produce the EFO independently while it is published on the Treasury website, which is what happened at this event. And that was a recommendation of the National Cyber Security Centre, who looked into what happened at the November budget. We produced the report in exactly the same way that we do normally, independently, and it was essentially transferred once it was complete to the Treasury to upload it on their website. In the future, we are still considering exactly what approach we'll use, but it is likely that we will publish on gov.uk, but on our own kind of site within gov.uk rather than on the Treasury's site.
Great. Well, that is probably a good point to end. Thank you so much to many of you for coming today, and thanks for the questions online, some of which we didn't get to, for which I apologise. We are always happy to follow up afterwards if you have questions or require further information about the forecast we've published today. I will wrap up by saying that we look forward to seeing you at our next event, which will be following the publication of our Fiscal Risks and Sustainability report in the summer.